Good morning and good afternoon, everybody. On behalf of Common and George Smith Partners, Sandy, my co-host, just want to take a moment to say a quick thank you to all of the attendees here for getting all of us on the panel to wear button-down shirts for the first time in ages. T-shirts were getting old, so we appreciate that. Seriously though, we appreciate everyone taking the time out of their busy day to join us virtually here to explore the future of multifamily U.S. rental housing now and tomorrow. I'm Zack Streit, one of the moderators, Senior Vice President at George Smith Partners. I work together with Malcolm Davies and the Davies Group, where we are debt and equity capital advisors to entrepreneurial middle market sponsors with a heavy focus on multifamily. We're based in Los Angeles, but also markets out of Denver and West. If everyone who isn't speaking could mute out, that would be awesome, because I'm getting some feedback here. No question that the multifamily market has been a bright spot, both in terms of performance and future projections during the COVID-19 era. In fact, we saw a report from one of the large property managers, and we'll talk more about this, that Vegas collections in May had already hit 79%. I thought that was interesting because Vegas is, of course, one of the hardest hit markets, but perhaps that continues to support the strength of multifamily. And we're definitely looking forward to input from our panelists on others and related topics. I thought what I would do to start is just a few quick housekeeping items before I turn it over to Sandy. So first, we encourage the audience members, and I think someone already has, to utilize the chat feature for Q&A. We're going to try and intersperse as many audience questions throughout the webinar as we can. And please direct as many questions to me that are tough questions so I can ask them to Jason and Erin, because that's going to do me a lot of good next time I try and send them financing requests. So, fire away. Second, and importantly, this webinar is off the record and closed to the press, so we appreciate the privacy. Third, finally, Sandy and I are going to direct questions to specific panelists, but all of you, please, feel free. Let's make this interactive. If you got something to add, we definitely want to hear about it. And with that, I'll turn it over to Sandy.
Thanks so much, Zach. Really appreciate it. Hi, everybody. Thank you so much for joining. I'm Sandy Albert with Common. I lead our real estate activities in the center of the United States and Boston and parts of Canada. And I'm getting involved in our dedicated national workforce housing operating platform at Common called NOAA as well. A big, huge thank you to, I think we got over 800 people potentially on this call, at least 800 people registered from far and wide. I know as far as Dubai even, and certainly all across the United States. So thank you very much for joining. Thank you to George Smith Partners and Malcolm Davies, my good friend and partner in crime, of course, Zack Streit of the Davies team at GSP. Thank you for co-hosting with us at Common. A special thank you and shout out to all the essential frontline workers out there in the healthcare industry and in the housing industry. All of our porters, cleaners, our property managers, our property techs, our leasing specialists, our building engineers who really do keep our industry running and who cannot work from home. We see you and we appreciate you. So thank you. And now let's start the show. A big welcome and thank you to our panelists from Heitman, Bank of the Ozarks, Six Peak, and Common. Why don't we start off with panelist introductions? We can go around the horn. And why don't we start off with you, Erin Spears from Heitman.
Hello, everyone. Thanks for joining us. I'm with Erin Spears with Heitman. I am an EVP of acquisitions for our value add fund. I've been with Heitman coming up on 2 years, and we are actively investing a $1 billion equity value fund and in the process of raising another $1 billion plus value fund for investments in all sectors, industrial, office, specialty. So we're very active and have quite a bit of dry powder to invest. And very excited to be on this panel with this esteemed team. So thank you for having me.
Great, thanks so much, Erin. And we'll go over to you, Jason Choulochas from Bank of the Ozarks.
Thanks very much, Sandy. Appreciate it. Hi, I'm Jason Choulochas, Regional Director for Bank Oaks EK. We changed the name about 1.5 years ago, but it's okay. We accept both names. I'm based in Los Angeles, California, and I'm responsible for our origination activity in Southern California, Southern Nevada, and Arizona. We're about a $22 billion bank, did about $6.5 billion of new lending, predominantly construction last year, and have been particularly active in the multifamily space over the last several years. Pleasure to be here.
Great, thanks, Jason. And Brad from Common, why don't we kick it over to you?
Thanks, Sandy. I'm Brad Hargreaves, the founder and CEO of Common. We are a residential brand and operator. We operate currently about 50 buildings in 7 cities across the United States, and we have approximately 15,000 units currently under development. We're a property manager first and foremost, but we operate in a centralized and branded way. We are best known as the largest co-living operator in the United States. We have a little bit under 2,000 co-living units currently under management. Best way to think about co-living is it's roommates done better, keeping the good parts of living with roommates, the social environment and the affordability, but getting rid of as many of the annoyances as we can control through things like cleaning of shared spaces, kitchen and bathroom supplies, splitting the bills for the tenants. But we do have 2 other brands. One I'm really excited about right now, we announced earlier this week, is Noah, which is our workforce housing brand, really serving Class C, Class B apartments, which are increasingly in demand as a source of affordable housing, particularly as we go into the next downturn. So really excited to be here. Thank you, Zach. Thank you, Sandy.
All right, great. And last but not least, Chris Aiello from Six Peak.
Hey everyone, Chris Aiello from Six Peak Capital here. Six Peak is a vertically integrated real estate investment company with operations mostly in Los Angeles, but we also have partnerships with local developer partners in Seattle, Chicago, and New York. We're heavily invested in the co-living space with over 2,000 beds coming online over the next 2 to 3 years, with the majority of those assets are managed by Common. So we've been very active in co-living and really excited to be on this panel with all you guys. Thanks so much.
Cool. Well, thanks everyone. I think we should kind of just get right into the questions now. So Erin and Chris, you guys drew the lucky straw to go first here. So we'll direct the first one at you guys. Maybe consistent with the point I made earlier about 79% collections in Vegas and segueing off of that. Tell us a little bit about the composition of your current multifamily portfolios, what performance is looking like to date, and maybe any early look into May collections I think would be interesting.
So I'll go first. Heitman's portfolios in multifamily is quite substantial. We're actually overexposed to multi, if there is such a thing. We've got about 9,000 units that we own directly within funds or for separate account clients. And the composition of our portfolio is 80% core, 20% value add, and then the product type within the traditional multifamily portfolio, about 40% is garden, 30% is high rise, and 30% is podium and wrap. We've selected assets in markets where we feel those assets will outperform in a recessionary environment. So our assets are in Texas and Austin and Dallas, in West Palm and Orlando, Chicago, Phoenix, Seattle, New York, and Atlanta. To date, our portfolio is performing surprisingly well. In April, we were 92% collected, and as of Yesterday, we were 73% collected. Within that 73%, over half of our portfolio is seeing collections over 90%.
Wow.
While the other half is below 70. And so if we kind of dissect it further, you know, the A+ kind of ultra core assets are the ones that are performing in line with our expectations due to the nature of the tenancy in those buildings. You know, very white collar, high earners. The majority of our tenants in those buildings are salaried employees who are working from home and continuing to get paid. You know, we are seeing the higher level of stress as it relates to collections in the B properties, where there's just more tension and more vulnerability given the sectors in which our residents work. You know, retail, service, entertainment, obviously those are the sectors that are getting hit the hardest. But we are quite pleased with our collection activity thus far. And one of the things that we're very surprised about, you know, this data changes day by day and it's very fluid, but in the past week, we've seen a very strong uptick in activity on tours and leasing. And some of our KPIs are really starting to turn positive this week. So that makes everybody feel really good. You know, and we are hopeful that our portfolio continues to perform very well, you know, into the summer and early fall.
Got it. Great. Chris.
The majority of our portfolio is actually still under development or in some phase of pre-development. We do have some projects that are open in New York, and the collections in April were fine. You know, obviously, you know, some people had some challenges, but we worked through them. So far in May, similar. I think, you know, we're going to end up probably in a really good place across everything that we do have stabilized. And obviously, everything that's under development in California is still moving really at the same speed. The projects that we have in New York are currently shut down until the, you know, shelter in place is lifted. But we expect to get those back up and running, you know, early this summer, and then, you know, finish them later this year.
Great.
Great. All right, Jason, let's kick it over to you and talk about what you guys are seeing in the debt market, in the lending space. What is changing in the multifamily construction loan market now? And how do you think, and how do you anticipate lenders are going to be adjusting their underwriting going forward?
Yeah, I think we're watching this all happen in real time, so it's evolving on a weekly basis. But you know, in general, we've seen a broad pullback in construction lending across all asset classes, including multifamily. You know, that's generally just due to the uncertainty over the broad economic picture. You know, individual banks, you know, seeing a slowdown in repayments of existing loans, and therefore the desire to do a lot of new lending is somewhat muted. The one bright spot or two bright spots are probably industrial and apartments. And so for sponsors with strong banking relationships and a track record, I think there's still ample debt, construction loan debt capital available to them. But my sense is that most banks are focusing on existing customers, servicing those groups, not looking to necessarily expand their customers or their book. Leverage is probably, if I had to wager a guess, down 5%. Pricing's widened out a little bit. Probably, you know, we saw some large construction loans that went from being fully underwritten by a bank to having a syndication requirement imposed upon the developer because the bank wasn't willing to hold the entire thing. So we've seen some of those changes, but with respect to construction financing, multi is definitely one of the bright spots.
Right.
Fantastic. So it sounds like a strong report thus far, both on the kind of sponsor equity and debt side. I want to bring Brad into the equation a little bit here. So Brad, how has co-living in common been impacted by COVID-19, if at all, with respect to collections, occupancies, operations, and what kind of changes are you seeing or thinking that Common is envisioning going forward? No question, there's been a lot of discussion. We've got a lot of questions in the lead up to this panel on this point. So love to hear your thoughts.
Yeah, totally. And the first thing to understand about co-living, it is primarily about affordability. People who are living with roommates, people who are looking for an affordable place to live in a major city. And so we really haven't seen any shift away from that. And in fact, our lead volume last week was as high as it's ever been. So we did see a hit to top of the funnel. So lead volume starting around mid-March and going until about mid-April, where lead volume at the top of the funnel dropped by about 30%, and then rebounded really between the second and fourth weeks of April. On the collection side, we really look at it in a couple of buckets. We have a co-living bucket, and then we have a traditional and micro apartments bucket. Our collections overall in April, the 5th of April, we were at 93.5% collected. Today for April rent, we stand at 96.5% collected.
Wow.
May so far, as of yesterday, we were 93.4% collected across the entire portfolio. The worst performing by far is our portfolio of micro apartments. That is under 90% collected. The co-living is actually the best performing across both April and May. And you see some interesting kind of case studies where in certain cities we have a micro apartment project at very similar rent, similar location to a co-living project. On average, the micro apartment rents are, the micro apartment delinquency is about double the co-living delinquency. And happy to get into kind of some reasons why I think that might be. So far we've been happily surprised on the collection side, and we do see leasing really start to recover. The biggest hit to the funnel was actually at the very bottom of the funnel. It was the conversion rate from paid deposits to signed leases. That is typically about 85% for us. In mid-March, that dropped immediately from 85% to 45%. And that's been slowly climbing back up. Last week, that was at about 60-65%, that conversion rate. So that really is a sign of dislocation. And if you look at the reasons why those deposits dropped, it's almost entirely macroeconomic. Somebody lost their job, their classes were canceled, their internship was canceled. There's a lot of dislocation happening right now. So demand is still really high. There's just a lot of uncertainty. So we've done a number of things operationally, and happy to walk through kind of the list of things we've done. We've increased cleaning. We've increased the provisioning of shared goods. Obviously people are living in our buildings. One really fortunate thing is we did a lot of virtual tours prior to COVID. So about 30% of all of our members were signed through virtual tours alone. So we were able to flip the switch in mid-March and convert to 100% virtual tours, actually even before we legally had to. And we've maintained leasing velocity. April velocity was pretty much the same as, was a little bit above actually February in terms of number of leases signed. It would normally be going up during this time of year, just given the seasonality. But we are happy with the return of leasing velocity, particularly over the last 4 weeks. We're not seeing a secular move away from co-living due to any kind of fear of a pandemic or contagion. Remember, these are pretty tightly managed spaces, and the majority of our members are not selecting co-living versus, say, a studio or private apartment. They're looking at co-living versus other roommate situations. So they're looking at us and saying, hey, at Common, we know you're going to clean every week. We know you're going to provide those kitchen and bathroom supplies. We don't have to go outside to get those. So we are continuing to see strong demand in our managed co-living spaces.
That's fantastic. So just a quick follow-up, Brad, because it must have been something you said. I think we got 3 or 4 questions that I'm seeing here between the Q&A and the chat. We'll put you in the hot seat first. So your point about micro units underperforming co-living seems to be one that's of interest. So what are your thoughts kind of as to why that is?
Yeah, so my hypothesis, if you look actually at the economics of people living in co-living versus living in micro apartments, even though they're the same price, the people living in co-living tend to be wealthier. They tend to be more in junior white collar roles, whereas micro apartments have a little bit more of a diverse set. You tend to have people in more blue collar roles. They tend to be a little bit on the hybrid of kind of urban multifamily and workforce housing. You know, we also, as I mentioned earlier, manage a workforce portfolio under the NOAA brand. Collections for our workforce portfolio, we have about 500 units currently, so it's still pretty small. But collections, they're around 89% for April right now. And that's a mix of class, anywhere from like class C plus to class B plus, all in suburban Virginia. And so we're happy with that collection rate that's above national averages for those asset classes. But if you look at kind of the tenant base, the economics, the income criteria, the occupations of micro apartment renters, they tend to be kind of halfway in between co-living renters, who are generally wealthier and more junior white collar, and workforce housing renters that tend to be, you know, much more rent burdened and more blue collar.
There also has to be a human interaction factor that can't be underestimated. I mean, when you're in a micro unit, you're all alone in a teeny tiny space. Whereas if you're quarantined in a co-living, you at least have some roommates to interact with to get, you know, life infused back into you. So that has to be at least a small component, but a component nonetheless, I would expect.
Yeah, and you even have you're spot on, and you even have a spectrum within micro apartments. I mean, you have some micro apartments that, you know, have a lot of shared spaces, a lot of common space. Those tend to perform better. And then you have some micro apartments, such as hotel conversions, that really are kind of, you know, little boxes in a hallway. And, you know, those tend to be tougher. And, you know, we do see issues from, you know, a tenant wellness standpoint in some of those more densely designed micro apartment layouts, and we have to take kind of active steps. We've been doing a lot of virtual community events, really trying to engage people to, you know, get people still socially interacting. There are people, I know they exist because we have a few employees on our team who literally haven't left their apartment in the last 9 weeks. And, you know, that's tough if you're living in a studio apartment or in a micro apartment in a place like New York. I do one last note that might be of interest. There's also a lot of, it varies a lot market to market. So we're seeing the best performance on the West Coast cities, San Francisco and Seattle. San Francisco, it's almost like nothing happened. Collections are great, leasing volume's great, occupancy strong. Seattle is pretty good. LA is decent. New York is by far the lowest performer in our portfolio.
Right. Well, we're getting inundated with audience questions.
Yeah.
Flip back to the
Great.
script. Go ahead, Sandy.
Yeah, it's great. No, keep the questions coming, everybody. It's really fantastic, and we're going to try and address as many of them as we can. I want to take it over to Chris and Jason. You know, continuing the topic of not only unit typologies, but of the design of multifamily, you know, currently and going forward. You know, we all really, I think, pay close attention to the design of our projects. How do you guys think that physical design of multifamily and rental housing will change as a result of what we're going through now? What are your thoughts there?
Yeah, it's a great question, Sandy. I mean, I'll give it to you from sort of the kind of the co-living perspective. And I think this is something that we were doing anyway. We were gravitating from, you know, when we first started investing in co-living to today, which is really kind of the emphasis on the ensuite bathroom. You know, I think post the COVID-19 world, I think, you know, getting someone to, you know, share a bathroom with another person, while I do think there's going to be a place for that still in the co-living space because of the affordability factor, I think we've generally been leaning towards more en-suites over and over again. And I think, you know, we even have some properties where we're planning on, you know, 100% en-suite, you know, layouts. And I think so post this event, you know, that's probably the biggest thing to kind of focus on is if everybody has their own bathroom, you have the ability to sort of be private inside of a co-living building versus, or co-living suite versus, you know, if I share a bathroom with that person, that's probably one of the most intimate sort of situations that you can be in. I think generally the rest of sort of the asset is, you know, largely the same. I think most of our common areas outside of gyms are really just more neutral spaces to begin with. So not much of a change there. I think, you know, with respect to a gym, I think that's something that is, you know, going to have to be thought through, figuring out ways to obviously keep that as, you know, clean as possible, which is something that Common does anyway. So, you know, largely the same from our perspective, irrespective of the, you know, the bathroom thing. And so, you know, we've been moving towards that model regardless. So I think, you know, we're in a good place to keep pushing that forward.
Yeah, I think I'd add to that, you know, from not just in the co-living space, and it's still, again, early days here, but the things that I'm thinking about that I could see happening in terms of apartment design, you know, are obviously analyzing cleaning costs and operating expenses just going up across the board, and the value of the amenities to tenants, that value proposition could change. You know, gyms are something that we're obviously thinking about, but if tenants, you know, are historically maybe, you know, had joined a gym and you know, 24-hour fitness or an Equinox or, you know, whatever, Crunch or whatever it is, you know, that the relative intimacy of the gym on site may be much more preferable. Maybe it was already preferable before, but it could be just from a density of population, even though the facility is smaller, it's at least a little bit more controlled. So maybe gyms will increase in popularity. I can also think about things like the office guys are talking about, looking at touchless entry, you know, surfaces that you touch, how, you know, getting into the building, you know, what are those pressure points? I can also imagine people at some point might discuss air handling, you know, ventilation, things like that, that, you know, can be improved and perhaps used as a way to attract tenants to, you know, to say you've got the latest and greatest in terms of, you know, ventilation and the like. I think too that, you know, the continued popularity of, especially in some of the lower cost Western markets, of, you know, low density single family for rent and single story stuff, apartments with your own dedicated entrance and perhaps your own private garage, are probably outperforming more traditional multifamily right now, because of, you know, lack of common areas that you lack of common areas that you're forced to go through, you know, through your entry experience. Instead of having your own direct access can be viewed very positively. So I think there'll be tweaks at the margin, but the tenants will ultimately tell the industry what they want, and we'll see some changes. But I don't see anything wholesale changing with the way we do apartments. I think it's going to be at the margin.
I was thinking about this morning, if I could just chime in. I think a lot of people are looking at this backwards, and I'm seeing a lot of the questions here. I think everyone's asking, you know, how do you design for social distancing, giving people more space, letting people separate from each other more? And I get why that makes sense for the next, you know, 6 to 12 months or however long we're going to be in this kind of pre-vaccine phase. The much bigger impact will really be around, will be macroeconomic. People will have less money. People will have less income. You know, the economic models don't show full employment recovering until 2024, 2025. That's going to be the longer term impact that people should be designing projects for today. So when we think about adapting our management in our spaces, there's a near-term need to help people socially distance, but there's a long-term need to how do we run these more efficiently? How do we keep rents low? How do we make sure that people who may have, you know, had a steady job making $60,000 a year pre-COVID are now working between gigs? They're trying to scrape things together. They're, you know, living off their parents post-COVID. So, you know, we've been looking at how do we drive expenses even lower, from cleaning to OS&E, to, you know, the spaces themselves. So we've been very focused on affordability. And when we think about post-COVID, we're really centered on how do we keep this a deeply affordable product.
Yeah, I think that's really interesting. One quick question, because we've gotten this a number of times before we shoot another one at Erin, just for the broader group. I've seen a few people ask, and I've read myself, do we think that co-working gets incorporated into co-living as there's more, I guess, telecommuting or folks that are working from home? I actually saw this on a couple projects up in Seattle. Won't mention them, but Common managed them, where there were like kind of co-working areas already incorporated as an amenity. Do you guys, and feel free, any of you, see that as a growing amenity base for multifamily going forward?
Absolutely. And, we at Heitman have introduced co-working spaces within our amenities, converting old amenity spaces that were underutilized, the gift wrapping room and the craft room that, was cute on a leasing tour, but nobody ever used. We converted a lot of those spaces into co-working, and the reception and the demand has been embraced very, very strongly by our residents. The fact that those spaces are not in use right now is definitely a pressure point. And we are being very thoughtful about how we will be reopening those spaces. But the co-working spaces, if you look at all the amenities across our portfolio, is one of the number 1 or 2 that's in highest demand to be reopened first. And if it's, using technology to make reservations for those spaces, we'll figure out a way to serve our residents' needs, because so many of them, they want to get out of their unit because they've been working from their unit and they don't have the printer, they don't have the screens, they don't have the right chair, that, they're sitting on the floor, their bed, or wherever it may be. So absolutely, I see it. And we also have co-working in office buildings that we own. And initially, everybody was kind of in freak out mode that those spaces would bring buildings down. And what we think is going to happen, and what we're already starting to see anecdotally, is that as offices reintroduce their workers into their spaces, what they used to have 150 square feet per employee, now that may have to double to 300 square feet an employee. And so larger corporations may be going to co-working spaces in the near term to lighten the load that their headquarter offices or their satellite offices may need to get people back in the office that want to be back in the office. So we're actually somewhat excited about the prospects for co-working, both in our multifamily projects and in our traditional office buildings going forward.
Great. Okay, well, no others. We'll keep it going with Erin. Thank you for that. So Erin, big question that we're fielding from a lot of our clients on virtually every call that we have. So how is equity looking at the current multifamily investment landscape? As a result of COVID-19, we're hearing that a lot of groups are kind of on the sideline at the moment, that there are a lot of groups that are gearing up for distress. Maybe less so in multifamily than other asset classes, but you hear it, to varying degrees. And these strategies could be note purchases, relief capital, buying distressed assets if they can. But we're curious sort of what the view is inside Heitman, in what opportunities you think are going to emerge from this, either in the back half of this year or early next year.
Obviously the answer always depends on who the equity is and what they're known for and what they're really good at. At Heitman, we're very fortunate to have a lot of different buckets of capital. A lot of that capital is core. And so a lot of the core players, people don't invest with them to shoot for the fences and take on very risky investment profiles. Some people are really good at that and they raise a lot of money around that, and that's their strategy. But if you are an institution that has a lot of core capital, you are very thoughtful and very protective of that capital. So if you're going to invest right now, when the future is so uncertain and the recovery, is it going to be 6 months? Is it going to be 6 years? Nobody has any insight into how long that's going to take. Most of the kind of core profile equity investors are sitting on the sidelines. And if they're going to make an investment, They're going to make sure it's highly structured. They're going to want to protect their downside, and they're going to want to make sure that they're getting paid for the risk that they're taking on, because we don't know the breadth of those risks yet. That said, yes, we are in the market. We're looking at opportunities. I invest on behalf of our value fund. And so I'm looking for kind of rescue capital situations, opportunities. I think that we're going to see emerge in the third and fourth quarters are going to be, buyers that were are over leveraged and are seeing stress in their assets because of collections and unemployment claims and the profile of their tenancy. I'm looking at note purchases, or looking at buying an asset from a lender that's in a foreclosure process. We're also looking at opportunities where, maybe somebody that was an office player invested in a multifamily asset and they're just having difficulty adapting to being a multifamily landlord versus an office landlord. I mean, they're different businesses. Other instances that I'm looking at specifically now where you see out of market players come in, invest in a market, and they take the mentality of the market that they're most accustomed to, and they try to apply it in another market, and they don't necessarily appreciate the nuance and the personalities of the markets that they've moved into. So for example, I'm looking at a deal that a New York developer did in Colorado. The New York approach didn't play well, and there's some distress there. And so that's kind of generic examples of things that we're looking at right now. But definitely only looking at things that there's a repricing or there's a misprice. We feel that the risk is mispriced relative to what the fix is.
Yeah, no, interesting. So quick audience follow-up before I turn it over to Sandy for the next question. I've been reading a lot because in addition to doing a lot of multifamily business, we do a lot of hotel business too. Obviously, that's a very different sector facing different challenges. But I've been reading a lot, and we've got a question here, and I'll address this to all the panelists broadly. Do you guys think there's going to be an opportunity in, say, the hotel to multifamily conversion, whether it be to micro units, which is maybe the most natural fit, co-living, traditional multifamily, just given what's going on in the hotel sector? And then to parse it one level deeper, we've heard commentary that, that sounds good in theory, but the actual cost of doing something like that could be extensive and potentially prohibitive. So very curious to hear, what all your guys' perspectives are on that.
Yeah, just maybe to throw in 2 cents. I think the most immediate opportunities are distressed multifamily assets that have been master leased to short-term rental operators. I don't think there will be any short-term rental operators in 6 to 9 months, and there are a lot of owners that are scrambling, looking for alternatives right now. So we see that as kind of the short term. And the great thing about those is they were designed as multifamily, so there's usually no legal or physical conversion required in a major way. Hotels, we've done some hotels, we've done some schools, some hospitals over time. We've done a couple of churches. It's all doable. It's really about your basis, your construction costs, the area. The one thing we do see that's really challenging, where we've never gotten a deal to pencil, is office conversion. It's be really tough. Certain markets like DC, everyone wants us to take a look at these, fat floor plate 1960s era office buildings that are really sucking wind, and I've never seen one pencil. We don't even underwrite them anymore, because your cost of, putting in the gas, the electric, the plumbing, changing the use, it just makes more sense to scrape it and start from scratch.
Great.
I think we'll see construction costs start to come down, which somebody mentioned in the comments, and that may, continue to push, the co-living and new construction as being a preferred method of increasing the housing stock. Adaptive reuses are nifty, but really aren't the easiest way to deliver units into a market and have a lot of embedded risk, cost risk. I mean, we see that in our portfolio all the time. a rehab is much riskier than a brand new construction deal, generally speaking. And so I think with the cost coming down, that bodes well for new development as opposed to redevelopment.
That's great. Yeah, I mean, sort of to piggyback off that, Jason, I saw a few questions coming in that you answered in the chat, so that's fantastic. Everybody should check that out. And then, Jason, to stay on that topic with you, you know, would you say that lenders will be more discerning going forward in general when it comes to financing traditional multifamily, co-living, student housing, and you know, how do you see yourselves approaching this, and how do you see the sort of individual sub asset classes within multifamily playing themselves out?
It's an excellent question, one that we're going through in real time. So for example, I would say regular way, market rate, urban multifamily, probably no substantive minor changes to underwriting, you know, but not anything that is going to, you know, be earth-shattering to anybody involved in the space. But one of the things we're wrestling with right now is student housing, for example. What if the universities don't go back to school? How many semesters? How much virtual learning versus in classroom? You know, it's unknown, and it obviously varies from campus to campus. But I think the UC schools are setting people up to be prepared to go back in the fall on a virtual basis. It's a huge system, and it's similar in many states. So we don't know what to do with student housing in the near term. We just don't. And so in the absence of clarity, lenders tend to do nothing. And that's what you'll probably see, a big slowdown there. I think in suburban multifamily, probably, you know, again, lenders will be more discerning because with the reduced amount of capital for construction in the market, predominantly reduced from non-bank sources, the banks will be more competitive and will have more opportunities to choose from, better opportunities. And so I think they're going to definitely be more discerning because the capital flows are tighter. I would think on co-living, and admittedly, we're really not in that space, but I think data and experience is the key. You know, I can probably tell you, you know, the traditional credit officer at a bank who's, you know, the Dr. No type of personality, he's going to say co-living. Oh my God, they're all going to be sick with COVID and what's going, you know, everybody will jump to the worst possible conclusion. And so what do you do in that case? You look at the real data, you look at the numbers, the hard facts. And so, you know, some of the stats that Brad has given and has been fantastic. And I think educating the capital markets further on co-living is really important, because I think the knee jerk will be, oh, that doesn't make sense anymore in a post-COVID environment. And I do not think that's the case, but I think ongoing education is going to be really important to ensure that capital stays interested in the space.
Mm-hmm. Totally. Yeah. Yeah, I'm seeing just one question that popped up in the chat, Jason, from somebody in particular, wanting to know if your builders in Louisiana, I would assume, and Nevada and Arizona, are you seeing, are folks saying that construction costs are coming down? This is actually a topic that I've been hearing about and reading about and following, and I know there's, you know, a lot of question marks there, but what do you think about cost in this environment?
Well, anecdotally, yes, costs are coming down. I think where you start to see it first is in your design professionals, your architects and engineers, because they have to do their work before the general contractor can really bid the job. And I'm hearing anecdotally of more competitive pricing amongst those groups. And so I would expect there to be a flow through. I think the impact of groups like Kilroy, who've announced that they're not going to do any more new development for at least a year. Prologis has suspended industrial construction. You know, some REITs are still going, some aren't. But in general, you know, construction is slowing, and those contractors who've been able to kind of name their price for their goods and services, I think are going to find a more challenging environment. I think it'll be more, I think the numbers will be less dramatic in markets like Arizona, where construction costs didn't escalate completely out of control. And so they'll come down a little bit. But I think LA has the potential to see a significant cost savings. And but we're still at the early stages. I've got a couple of projects that we're financing right now that are literally, out to bid right now, and we'll see where the GMP comes in. But if I had to take the over or the under, I might take the under right now on construction costs.
Great.
Yeah, we're already seeing it a little bit on some projects that are currently under construction where we're getting buyout savings already on a few trades, mainly around lumber. But I do think that, over the next 6 months, we're definitely going to see, sort of a flattening. And I think from an underwriting perspective, we've been underwriting escalation for costs kind of going up in the next 3 years, prior to COVID. And, hopefully that's something that we can, remove from our underwriting, or at least look at it as upside. So we're really excited to see how these projects come down, especially if rents come down slightly, which I'm sure is likely. That'll coincide with a good yield on cost still on those deals.
Yeah, it's interesting. We're hearing the same. We're hearing that construction costs are finally going to moderate or de-escalate, is the way I'm hearing it said. We've heard it a little bit. I think one of the comments mentioned it on the lumber side. And then the big question is, are we going to see it on the labor side? And, if I had a crystal ball, I would think yes, but it can vary market to market. So those are interesting questions. I also echo what Jason said, from a financing standpoint. We think we see some green shoots of new lenders, starting to re-enter the market, but, certainly, what's been the case is there have been fewer, and as a result, there's just less supply of capital. And, at the moment, folks can afford to be, or the lending folks can afford to be choosier and like really rifle shoot where they want to take their risk, as opposed to 3 months ago where there was, very significant liquidity and competitiveness in the market. So I see that we only have 10 minutes left. So I'm actually going to skip a little bit forward on our questions, but I'll point this one to both Jason and to Brad. This is a question that I've seen a number of times in the chat feature we have here. So I thought it would be interesting, and it's one that people have talked about. And so we're curious if there's any evidence of a flight to the suburbs and tenants moving away from urban environments. And then also within urban environments, is there any evidence of a move towards less dense living environments, as a result of COVID concerns, or is it too early to tell?
Yeah, I'll happy to take a whack at that. I mean, look, I believe that social interaction, in-person social interaction, is something that people want, and that's not going to change, that's innate, and that in 12 months, 18 months, when we have a vaccine or there is some established treatment, or we've simply reached herd immunity here, that people will still crave those things. They will still crave the interaction. They'll still crave active spaces, and that's not going to fundamentally change. I think some wealthier urban tenants, people who have optionality, will absolutely near term, for the next 6 to 12 months at a minimum, leave for the suburbs, and some of them may stay there. But the next generation, the Generation Z, the 22 to 25-year-olds, even the 25 to 30-year-olds, they want to live in cities. They want to interact with each other. They want to be on Tinder. They want to date. They want to go out to bars. Like, they want all those things. All those things are a lot harder to do from a single-family detached home in the suburbs. So I'm still long-term, even intermediate term, very bullish. And if you look at Commons tenant base, I mentioned affordability. People come for affordability, but they stay for the community. If we look at one of the biggest correlations to renewals, our renewal rate is around 50% on leases. And, the biggest correlation is, have people been to an event, a common event, or do they know people outside of their own suite who live at Common. And so when I look at that, I see that there is that need for community, that need to interact with others. I think obviously we're in a very strange period right now, but that's going to come back. And if you look at a lot of the projects in our pipeline, I mentioned about 15,000 units under development. A lot of the things Six Peak is building, those deliver in 18 months, in 24 months, when things will be back and people will be coming back to cities. They may not be coming back as wealthy as they left, though. They will be coming back in a downturn. And so when we think about the long-term impact, as I said earlier, it's about how do we design those projects for affordability. And in some ways, there's a tension between affordability and space. People would love to have a big, spacious one-bedroom apartment in a highly amenitized building, but most people don't make north of $100,000 a year, even people living in expensive coastal cities. So we have to design for the audience that's there, where there's the real need. And so we're really thinking about when we do see that, we do see these buildings open, we see this resurgence, how do we make sure that we're there to serve people who, have been economically challenged for the last 12 to 18 months? And that's a tough question.
I think Brad made a bunch of excellent points there. And I think, in certain markets, and this is just anecdotal, but if you talk to your friends in New York and Manhattan and high-end apartment buildings, most everybody's taken off for Connecticut or for the Hamptons or wherever else they may have some housing choices. Not everybody is going to fall into that category, but there may be a component of those renters that may elect not to come back. But that's a renter by choice, typically not a renter by necessity. And so I think that'll only occur at the margin. I think in the Western states, our urban environments aren't nearly as dense as New York or some of the East Coast markets. And so I think that we won't see a flight to the suburbs there of any significant capacity for all the reasons that Brad described. I think young people without kids, unmarried especially, want to be in a more urban social environment. And the suburbs, they ain't changing. They're the suburbs, and they are what they are. They're not for everybody.
One thing I real quick want to interject in that comment is we are seeing a shift in unit demand for inquiries on new leasing. For example, we're accustomed to seeing very, very robust demand at this time of the year for studio rentals. We are seeing less demand for studios and a much higher demand for 2-2s or 2-1s even. So the residents that have the economic ability to size up are inquiring to do so. So that was an interesting statistic that I asked our asset managers, and it was also backed up by what Yardi is seeing across all the units that they manage. So it may not be a complete change in your living environment externally, but people are looking to make changes in their living environment internally. That means a bigger unit, or they want in-unit laundry. That wasn't as important to them before. It's more important to them now. Moving to a building that has more elevators. So those are some of the shifts we've seen in the past 60 days. We don't know how long they'll continue and how much value, additional value, will be placed on things like balconies in a high-rise or in a podium building. How many people, instead of paying a premium for a higher floor, maybe you start paying a premium for a lower floor so that you can use the steps if it's 2 people per elevator ride. So some things that we didn't necessarily anticipate. Residents' consumption patterns have changed in the near term. We'll see how much of that sticks in the long term.
I think the other thing to think about too, with respect to, cities, is that, we've had obviously some job loss here, but as things kind of recover over the next, 12, 18 months and continue past that, the job growth is still going to be located in cities. And even if office space usage changes, I think historically, you're not going to go from a 0 work from home strategy, to a 100% work from home strategy. It probably will still be a mixture, which means you're still going to want to be close to your job, especially as the new jobs that are in cities are growing. it's not like Netflix all of a sudden is going to open their office building 2 hours outside of LA, right? It's going to be in Hollywood. And so I think everyone needs to remember that, housing follows jobs, right? And so the job growth in these cities is going to eventually bounce back and continue to grow, and the housing will follow it, and the demand for housing will follow it.
Awesome.
Yeah, great.
Yeah, awesome. Seeing a ton of great questions coming in from everybody, and I think hopefully a lot of these topics are getting addressed. So this is phenomenal. And I don't know, Zach, if you agree, maybe we just go around the horn one last time. I think we have about 3 minutes left. And look, from my perspective, guys, and everybody, what does the future of rental housing look like? Sort of what I would say, if you could summarize what keeps you up most at night right now, but at the same time, like, what are you most excited about, going forward in terms of multifamily and rental housing in the U.S.? I don't know, Zach, do you think that's a good place to end?
I think it's a great place to end.
All right,
Positive.
Jason,
you guys can tell us some of the negatives, but tell us the positives.
Yeah, Jason, why don't we start with you there?
Well, I think from my perspective, I'm pleased to see that the asset class is performing so well, and that'll ensure that capital continues to flow towards housing, and it's a resilient asset class. I'm still concerned, especially in the Western markets, about zoning and entitlement and the anti-development nature of all these markets, that even if we want to make changes in the way we do multifamily, even if it was in the public's best interest, the political environment isn't such that, you're going to see wholesale change. So I'm bummed about that, but nonetheless, I think that the asset class has got a bright future ahead of it, and one that the capital markets will continue to recognize going forward.
Yeah, I think from my perspective, it's a couple of things. I think, pre-COVID, we were very focused on exactly what Brad's talked about, which is, the affordability factor. And I think nothing's changed with respect to that. And so investing in markets that have a supply-demand imbalance for affordability, I think, is still going to resonate really well over the next 2 to 5 years, no matter what. And I think, the emphasis on, technology and, remote leasing and, automatic payment services and things without a lot of friction, I think are going to continue to need to be invested in as well. And just generally, like, investing in sort of that, technology driven housing plus affordability mixed together is what the next generation of renters wants. And, I think that's what we're going to be focused on here in the next, near term and long term.
I'm personally really, I'm a Darwinist and a capitalist in my heart, and I believe that desperation is the mother of all invention. And so while as intense and scary and overwhelming and stressful as this whole thing has become, I think there's going to be so much innovation that's bred out of all of this. And the really strong operators, the ones that, have built a foundation, for their operations that are virtual and, have very strong technology, are going to outperform. And so we're very bullish about the fact that we have aligned ourselves with phenomenal partners and operators. I think that single family homes for rent are going to become a more broadly accepted institutional asset class. And, I may sound a little self-serving saying that, because Heitman is very invested in single family homes for rent, but we've seen that sector of our housing portfolio perform exceptionally well. To say it's on fire would be an understatement. But there's change coming, and that's not necessarily, that change is not a bad thing. And so I'm looking forward to all of the new technologies and utilization of space that's more efficient and serves the residents in a more kind of holistic way. So I know that's basic in general, but we're fortunate to be overexposed to multi, and we are lucky to have a very diverse multi portfolio, and just we'll continue to grow it.
Yeah, thank you, Erin. I want to lean into that point on technology. I think the next decade is going to be about technology coming into real estate, but particularly into residential in force. And so far, technology, when it's been deployed in multifamily, has largely been kind of a whiz bang, impress the luxury tenant kind of thing. I think that's going to get flipped on its head. Technology will be about efficiency. It'll be about efficiency of operations. How do we run these things more affordably, more efficiently? Give you an example. I mentioned virtual tours earlier. We were doing 30% of our members closed through virtual tours alone. The reason we did that, it was a nice service for our tenants, but it decreased the need for leasing specialists, leasing agents on the ground. It meant that we needed less staff at the building, which increased NOI for our owners. That's incredibly important for workforce housing. Why did we get into workforce housing? We got into workforce housing because the technology we're using, the virtual tours, are really increasing the efficiency of operations. You need fewer building staff when you have a lot of technology and automations in place. So I think the next decade will be one of technology, but not the kind of technology we've necessarily seen to date. Software technology as opposed to hardware, and focused on efficiency and affordability as opposed to the whiz bang. So thanks everyone for having us here. Thanks, Sandy. Thanks, Zach.
Hi, this was great, everyone. Thank you. We're 3 minutes over. I've never seen this many questions on the Q&A and the chat, so it had to be epic. So just a big thank you to Common, to Sandy, to Brad, Erin, Chris, Jason, and we got to do this again soon because it seems like you guys are in high demand.
Thanks, Zach.
Thanks, everybody.
Thanks for having us.
Thank you, everyone.
Have a great day.